Well, this chapter is going to get a little bit more complicated only because there's so much information to look at. When we're talking about leases, the first thing we want to go through are these classification tests because that's going to help us determine how to account for this lease. Is it a finance lease or is it an operating lease? So let's look at these classification tests. The first one is the transfer of ownership test. And all of this does is say, does it transfer ownership at the end of the lease? That's the only thing that test is looking at. Is there transfer of ownership to the lessee at the end of the lease? The purchase option test, is there an option to purchase at the end of the lease? And you also want to look at, is the lessee reasonably certain to exercise this? Are they probably going to purchase it at the end? This also is sometimes referred to as a bargain purchase option. Think about when you lease a car, and sometimes they have an option to buy at the end if you choose to do so. All right, let's look at the lease term test. So what this is looking at is the lease in number of years. Is it 75% or greater than the life of the asset? So how long is that lease term in comparison to how long that asset is going to last? Another thing you might want to look for, or some keywords, is a bargain renewal option. The present value test, this is looking at, and we're going to get into the tables, and I'm going to show you how to use those, so don't get too concerned. People tend to get scared about those tables, and it's really just a simple thing we're looking at. So the present value, again, is looking at how much is this worth to me now, and the present value, if it is the sum, if it's equal to the sum of the lease payments plus any residual value guarantee that the lessee has to pay at the end. If all of that is greater than 90% of the fair value of the asset. So that's what we're looking at there. First, we're going to look at the present value, and that's all of your lease payments combined plus the present value of your guarantee, and is that greater than 90% of the fair value of the asset? And finally, this last test is the alternative use test. And this is this asset something so specialized that it's expected to have no other use if it's returned to the lessor? I think we should make sure we understand the difference between lessor and lessee. So let's make a quick note up here, because sometimes when we're reading all of this information and these words look so similar when you're looking at reading this kind of accounting text, we want to make sure we distinguish the difference. So the lessor is the person who owns the asset, and they're leasing it to the lessee, who is now signing off and kind of renting this asset by lease from the lessor. So they are going to, we'll just put rent from the lessor. So that kind of just gives you kind of some plain terms when you're reading through these and the wording gets complex, to know who is doing what. So let's look at, from these classification tests, what do we do with that? First, from a lessee standpoint, if you answer yes to any of the above questions, any of these tests, and the lease is non-cancelable, then it's classified as a finance lease. So if we answer yes and it's non-cancelable, it's going to be treated as a finance lease. The opposite side, if you answer no to any of those, or it's non-cancelable, I should say cancelable, not non. Then it's going to be an operating lease. Looking at it from the lessor standpoint, or the person who owns these, let's look at that first, and then we'll go back and go through the differences between a finance lease and an operating lease. So from a lessee standpoint, we're looking at yes, looking for those questions to be yes, and then it's going to be a finance lease, or if it's no, it's going to be an operating lease. From a lessor standpoint, if any of these tests are met, then the lessor has transferred control. Those are some key terms we want to look for. Did they transfer control? That would be saying yes to these tests. If they did transfer control, then it's a sales type lease. For these sales type lease, the lessor records it similar to the sale of an asset. We would record a lease receivable, just to give you a little idea. Let's get some journal entries in here. We record a debit to our lease receivable. We're going to record a credit to our sales revenue. We'd also have to record that we're selling that inventory. So we're going to debit our cost of goods sold with that and credit our inventory if it is a sales type lease. The other thing we have to consider is if it's collectible or not from the lessor view. If it's collectible, if it's probably going to be collected, we record that receivable. If it's not probable, then we're going to record the lease payment as a direct liability, or deposit liability, sorry. And we would do that just by recording the fact that we received cash and credit deposit liability. So just to go back, from a lessor standpoint, we never said, well, what if it's no? If it is no, then it's going to be used as the operating approach, recording it as an operating lease. So let's talk just for a second what the differences are between a finance lease and an operating lease. So now the first thing that we really want to understand is it a finance lease or operating lease? And from a lessor standpoint, is it a sales type lease? I guarantee you're going to see those kind of test questions. So make sure you understand these classification tests and what has to be met. And understand, are you looking at the lessee or lessor, determining if it's a finance lease, an operating lease, or if you're going to record this as a sales type lease. Now let's go into a little bit more detail about the different types of leases. So your finance lease, we're recognizing interest expense over the lease liability, over the life of the lease, using that effective interest method, and we're going to record amortization expense on the income statement. So from a lessee standpoint, again, we have interest expense on the lease liability. We're going to use that effective interest method, and we're going to record an amortization expense on this right of use asset. And that's going to go on your income statement. From the operating standpoint, we're still going to measure interest expense using that effective interest method. We're still going to amortize this right of use asset. The difference is this amortization on the operating lease is going to be the same from period to period. So the amortization and therefore the interest, the expense, the lease expense is going to be the same every period. And I know that's a little confusing to kind of write down, read through. I think that's one of those things that once we start doing these journal entries and start looking at the homework, it's going to be a lot easier to understand. So let's go through one of those homework problems, hopefully help you understand how this works and how to record these different things. So this one is 21-8. I'm going to go through this homework problem with you and hopefully get you started in the right direction. So again, they're giving you a lot of information. So first thing that I want to do is kind of pull out who's the lessor, who's the lessee. So when they start asking questions, I kind of know what they're talking about. So this Krasel company I can't draw a straight line. They leased a machine to Dexter Company. So Croswell is the lessor. They leased it to Dexter, so they're the lessee. Going to make a difference in our recording. This all happened January 1st, 2020. The lease is for an 8-year period. Requires annual payments of $35,004. The beginning of each year. We purchased the machine during 2016 for $160,000, and collectability is probable. That we needed to know that, because that's going to make a difference in how we record. Annual interest rate is 6%. The machine has an economic life of 10 years with no residual value, and some other information. They assume Dexter Corporation does not know the rate, and Dexter's borrowing rate is 8%. And then there's some other direct costs to Dexter. So again, a lot of information they throw at you. You know we're probably going to need the 6% rate. They're also giving me an 8% rate. Not sure. You can go ahead and highlight that if you want to, but we're going to look at first the Crosley's books and see what we need to do with that. So the first thing we want to compute is the lease receivable. Remember, lease payments are probable. Therefore, we're going to record a receivable on Crosley's books. And how much is that receivable going to be? Well, we have to find the present value of these payments. So I'm going to look at the equal amounts that I'm going to get, 35,004. Since I'm getting them every year, that's the definition of an annuity. So I have pulled out that annuity table for you to look at. It's right here. Your book is going to give you one as well. The numbers are a little longer. So make sure you use all the numbers that your homework shows. Otherwise, you're going to be off a little bit for rounding issues. So as we go through, we're going to find that rate that we need to multiply this annual payment by in order to find out what our lease receivable should be recorded at. So I know that I'm looking at 8 years, because it's told me that this lease is an 8-year period. And I know that that rate that I'm looking at, I already highlighted, with 6%. So I'm going to find that 6% and I'm going to see where those meet. That gives me a rate of 6.582. Now I know I'm on the right table. When your homework pulls it up, it automatically goes straight to the future values table. Make sure you scroll down, look for that present value of an annuity due, and make sure that you're looking, and if you're looking at an annuity, all of these numbers should be greater than 1. That's how you know, some little hints to make sure you're on the right table. So if I do that math with a little bit of rounding, it comes to $230,410, and that's what the lease receivable would look like. Now I wanted to show you the contrasting difference here. So what about Dexter? Remember, Dexter is the lessee. Usually if you have a receivable and the liability from the other side, you're recording the same amounts, but this is not the case, because the Dexter's borrowing rate is 8%. We're still looking at those 8 years. So we're still looking at the 8 years for Dexter, but now we're looking at 8%. So So they're going to be recording a different borrowing rate, which is going to give us a different liability. So 35,004, but here I'm multiplying that by 6.206, which is going to give me an amount of 217,248. I just wanted to make you understand the difference there. And this is an 8. But also, on Dexter's books, looking at this right of use asset and what that would be recorded at, remember, if they have an initial direct cost of $15,000, we need to add that to the cost. So we're going to take that lease liability and we're going to add that $15,000 in. So my right of use asset is going to be recorded at $232,248. So remember, this right of use asset is initially valued at the same amount as the lease liability plus the initial direct costs minus any lease incentives received. We don't have any of that in this problem, but we do have those initial direct costs. So we want to make sure we include those. So I just wanted to show you the difference between the lessor and the lessee and the different recording amounts we're going to be using in those journal entries. So let's go back to Crosley. And let's go through some of their journal entries. When we do look at these journal entries, we have to determine how they're going to record it. Crosley, remember, is the lessor. So we have to look, are they recording it as a sales type lease, or are they recording this as in the operating approach? Now, if we go back to this information, we know this is an 8-year lease and that the asset life is 10 years. So we have an 8-year lease, the asset life is 10 years. That's giving me 80% of that asset's life. Our test said that it just has to be greater than 75%. And then we would record that sales type lease. So because it's greater than that 75%, we are going to record that sales type lease. So that initial journal entry, we're going to record it as a lease receivable. We already calculated the amount. Remember, we have to record also that cost of goods sold. And your homework likes to do this all in one journal entry. That cost of goods sold is going to be what we purchased it for, of $160. And then we're going to record a sales revenue. This is for the amount of that lease receivable. And then also decrease our inventory. Now we also have to record that first lease payment. Remember, they're receiving equal annual payments of $35,004 at the beginning of each year. So we need to record that we got that. We got cash. 35. And we're going to record that to our lease receivable to decrease that amount. So at the end of the year, we also get interest on this. We're going to need to record that interest. So if we look up at how much interest we had to pay, I'm trying to get, there we go. They're going to get 6% rate of return. So we're going to use that to calculate our interest. And because we're using that effective interest method, we have to calculate our interest by taking our receivable minus the amount that was paid, and we're going to times that all by our 6%. So when we record that interest revenue, we're going to actually debit our lease receivable. So that $11,724, and we're going to debit our our interest revenue. So this is happening at the end of the year. This is happening all at the beginning of the year. So what about, we're just going to throw a couple of scenarios, just show you the difference in the journal entries. What if it was not probable that the collectability of these lease payments was not probable? That means, remember, if we go up to our notes, which are pretty far up here, if it's not probable, we're going to record it to that deposit liability instead of to our lease receivable. So we're just going to record when we receive that cash on 1/1/35004, and that's going to go as a credit to our deposit liability. Another scenario, suppose at the end of the lease term, they receive the asset and determine it actually still has a fair value of $1,000 instead of what they thought was going to be a residual value of 0. That means that they can recognize a gain on that. So we're going to put that inventory back on our books by debiting inventory. And we're going to credit our gain on lease. Now, as always, I want to show you a little bit of how these homework problems translate into exam problems. This would be a great time to stop the video, put it on pause, maybe see if you can do this on your own, and then come back and see if you got it right. So let's walk through this problem. It's looking just like the one we just did, except it's only asking for pieces of that journal entry. And it's kind of taking it like one step further than what that initial homework problem did. But we're still going to have to do some of the same things. So they have Hawk Leasing Company. They're the lessor. And they lease equipment to Harper, which is the lessee. And 5 equal annual installments. We're looking at, they guarantee a residual value of $100,000, and they give us Harper's incremental borrowing rate as well as Hawk's interest rate. So what we want to figure out is, looking at it from Harper Company's standpoint, which is the lessee, what kind of journal entry do we have to record on January 1st, 2021 when we record that second journal entry? They want to know, what is your lease liability at that point? The first thing that we have to do is figure out what our present value is, right? Because that's what we recorded that lease liability to begin with. So to do that, we're going to have to take our annual payments, and we're going to find a factor to times that by. Because Hawk's rate is 8%, we're going to use that 8% borrowing rate or interest rate, and we're going to find the factor that goes with that. 8%. This is an annuity due because we're going to get this multiple times. So we're going to times this by 4.31213. We're going to take this number. Remember, we have this $100,000. But this we're only going to get one time. We're going to get this one time, and we're going to get it in 5 years. We're still using that 8% rate. So we're looking at that 0.68508. So the difference here is looking at this payment, $160,000, we get multiple times. That $100,000 we get once. So the multiple times, the factor should be over or greater than 1. If we're only getting that payment one time, our factor should be less than 1. If I do all that math, I can find my present value of $758,449. That's not what they're asking for, though. They're asking for that to record that second lease payment. So I'm going to have to using that effective interest method, I take the $758,449 and subtract that payment I made originally, times this all by 8%, and it's going to tell me my interest amount was $47,876. This is my interest. That's not what they're asking for. They're asking for the liability. So I would take that $160,000 payment, subtract my interest to get my liability. That's the only one that has that number. So, and all of these are kind of the same anyway. So, but in case you needed to know what that journal entry actually looked like, what we're going to do is debit that lease liability. We're going to debit that interest payable. This is due like the next day, on January 1st or 2nd. And our cash. The cash isn't going to change. That's the $160,000. That interest we figured out is $47,876, and therefore my lease liability is kind of a plug figure of $112,124. Ran out of space. So that kind of shows you what you're going to need to know and how we can take some of these homework problems and look at them, especially a harder exam question, because this does take it a couple steps further, adds in that residual value. So just giving you a little bit extra. Sometimes those word problems are even harder because they all just seem to say the same thing. So looking again at the same problem, if this lease had a bargain purchase option, what impact would that have to Harper Company? Well, let's think about what we have to do with that bargain purchase option. And that is going to be an increase to the present value of the minimum lease payments by the option price. We know we're not going to decrease, so we can eliminate those immediately, and then there's no impact. So really, if you knew that that bargain purchase option increased your or had something to do with an increase, you would know the answer to this. So if you didn't know that, try to play a process of elimination and find the one that makes the most sense. So hopefully that helps. If you have questions on this, because I know it's a lot, please let me know.